Today I'm going to talk about the Roth IRA contribution limits for 2019. I'm also going to go over, as you can see up on the board, some of the facts and figures, how much you can save, when to save, how to save, what is a Roth IRA good for. If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner with Sickle Hunter Financial Advisors. So let's start out talking about what a Roth IRA is and how it works. So it's a retirement account, or primarily a retirement account, that you can put in earned income. So these are dollars that you're earning from a paycheck that you can put directly into the Roth IRA. It's going to go in with after-tax dollars, which are dollars that you're getting in your paycheck. So it's the money that you're getting from your paycheck. Those are after-tax dollars that go into the Roth IRA. They're going to grow tax-deferred and hopefully come out 100% tax-free in retirement. Now, there's a couple of ways that you can pull it out early, which I'm going to go over in just a minute. So before we do that, let's talk about the contributions or the changes for 2019. As you can see up on the board, contribution limits have increased by $500 to $6,000. So in 2018 and prior to that, it was $5,500 a year. Now it's $6,000. That's kind of nice. And if you're 50 and over, so if you're 50 and over, you can do an extra $1,000, bringing the total to $7,000. Now it's important to know that it's 50 and over and not over 50. So if you're 50 or over, you can contribute an additional $1,000. So that's the maximum contribution. Now, what is a Roth IRA good for? So, three things that I've pointed out right here. Anything that you put into the Roth IRA, you can pull out of. So that's called your contributions or your principal. Anything you put into the Roth IRA. So if you put in $500 today, in 2 weeks you wanted to pull that money out of the Roth IRA, you can. So the money that you put into the Roth IRA, you can pull out. Now the growth, that is a different story. So let's rewind. Let's say that you put in $500 into the Roth IRA. 6 months later, you decide, I really need that money for whatever reason. I can pull it out tax and penalty free. You've already paid tax on it, so that's why you're not going to pay additional tax on it. And it doesn't have a penalty because it's the contribution that you put into the Roth IRA. Now, any of the growth, that is what will have the penalty and the potential tax liability to it on the growth if you pull it out before age 59 and a half. So to be clear, there is no 5-year rule. There is no rule that prevents you from pulling out the money early as long as it's only the contributions. So the second one is looking at $10,000 first-time home buyer. This one's a little different and quite interesting. So you could pull up to $10,000 out of your Roth IRA for your first home purchase. Now, the other part of it is you actually don't have to have your first home purchase. You just can't have owned a home in the last 2 years. So if you haven't owned a home in the last 2 years, you could pull up to $10,000 out of your Roth IRA. And that includes growth. So if you put in $5,000 into the Roth IRA, over time it grew to say $10,000, you could pull every single penny out tax and penalty free. So that $5,000 of growth, you'll have never paid any tax for it as long as you use it for your first home purchase or the purchase of a home that you haven't owned a home within 2 years. And the third one is looking at college tuition. So with college tuition in a Roth IRA, you can, of course, pull out all the principal because, as we said in number one, you can pull out the principal at any time for any reason. So if you want to use that portion for college savings, then you can. On the growth side, if you use it for tuition, you can pull that money out. You can pull the growth out and avoid the penalty. So it's penalty free, which is 10%. So you're not going to have to pay that penalty, but you will have to pay ordinary income on the growth if you use it for college tuition. So yes, it is penalty free, but it's not tax free. So if you use the same example as we did with the first time home buyer, then $5,000 would be the principal. And if you had the additional $5,000 in growth for college tuition, that $5,000 of growth would be as taxable income. Now let's go through some of the Roth IRA contribution limits, or the amount that you can actually put into the Roth given your income level. So if you're married filing jointly or a qualified widower and you make less than $193,000, you can put in up to the limit. Now, why didn't I just put in $6,000? Because if you're 50 or over, you can do an extra $1,000. That would be $7,000. So it depends if you're 50 or over, would depend on if you could do $6,000 or $7,000. So if you're under 50 and you're married filing jointly and you make less than $193,000, then you can put in up to $6,000. Again, if you're over 50 or over, then you can do up to $7,000. That would be your limit. So with married filing jointly, if you're in the phase out range, so that's between $193,000 and $203,000, it's a reduced amount, it's prorated. And I'm gonna go over the phase out range and how to do that math in just a minute, but first I'm gonna go through the rest of these numbers. So if you make over $203,000, you can't contribute directly into the Roth IRA. So it is zero. You've exceeded the maximum amount that you can put in. But there are other ways to get money into the Roth IRA, but we're gonna save that for another video. If you're married filing separately, it's extremely low. Most of it is. It's less than $10,000. It's always prorated. And if it's over $10,000 that you're making in income, then it's a reduced amount. Excuse me, it's zero. So married filing separately, if your income is less than $10,000, then it's a prorated amount, and that's the reduced amount. So let's say it's $5,000, then it's half, and that's again the phase out range. So then you'd only be able to put in $3,000 if you're under 50. So that's less than $10,000. So married filing separately doesn't allow you really to save into anything or get a lot of the tax breaks that you could if you're single or married filing jointly. If you're married filing separately and you did live with your spouse at any point of the year, you're gonna have a difficult time saving into your Roth IRA because the limits are very, very low. And it goes up to the single limits, which are more favorable if you're married filing separately and you did not live with your spouse at any point during the year. So single, head of household, or married filing separately, less than $122,000 up to the limit. So again, if it's $6,000, then you can put in the $6,000. If you are in the phase out range, now this phase out range is a little different. It goes from $122,000 to $137,000. And again, it's the same prorated amount. So let's go through some of the phase out ranges. I'll walk you through some of the math. So if we see right here, married filing jointly, let's take this phase out range of $193,000 to $203,000, and let's see how that math works. So let me pull this board down. So let's take a look at this. So we have $193,000 to $203,000. So we can put dollar signs there too. So $193,000 to $203,000. So that's what we're dealing with. So that's a range of $10,000. Now let's say that we make $194,000. So what I'm gonna do is I'm gonna take $194,000, how much we've made, and I'm gonna subtract the bottom range, which is $193,000. That is going to give us $1,000. Now, because we know that our range is $10,000, we're going to subtract $1,000 from the $10,000. So $10,000 minus $1,000 gives us $9,000. So now let's take that $9,000 and divide it by our range. So our $9,000 divided by our $10,000 is going to give us 90%. So we can do 90% of our maximum limit. In this case, let's call it $6,000 because we're going to be under 50 years old. So it's 90% of 6,000. So what we can do is we can do 6,000 times 90%. Or you could just do 0.9. So if you're doing it on a calculator, do 6,000 times 0.9, and that's going to give you $5,400. So this math will work for any amount that you make within the range. So if you did 195,000 minus 193, that would be 2,000. Bring the 2,000 to here, it would be 8,000. We bring it here, 8,000 divided by 10,000 would be 80%, and so on and so forth. So we'd be able to take 80% of the 6,000. So that's how you figure out the phase out range. Now the math will work the same, and I'll bring the board back up so you can see it again. The math will work exactly the same, and we can go through it. So the math will work exactly the same if we're looking at single, head of household, or married filing separately. But the only difference is the range is going to be different. So down here, you can see it's 122 to 137. So that's over a larger range. So you have $15,000 instead of the 10. So the math would be a little bit different. So let's go through that math. So it'd be 122,000 to 137,000. So with the 122 to 137,000, that's going to be $15,000 difference. So the range is going to be over that 15,000. So we're going to do exactly the same math. So let's say that we make 125,000 in this case. So it's 125,000 minus, again, the lower range is 122. So it's 122,000. That's going to give us $3,000. So what we want to do at this point is we're going to take our 15,000, again, our range. So it's going to go here. The range is going to go here. 15,000 minus this 3,000. 3,000 is going to equal 12,000. So we'll do the 12,000 divided by the 15,000, and that is going to give us our 80%. So with our 80%, then we're going to do 80% of the same amount because it's still the Roth IRA, so we're still going to do $6,000. So we'll do 80% of $6,000. So again, we'll go through the math. 12,000 divided by 15,000 equals 80%. So 80% of, so we'll do the 6,000. Again, multiply it. In this case, you can just put the 0.8. So the same one I put percent before, or you can put 0.8. Either one's the same thing. So that's going to be $4,800. So in here, we're going to have $4,800. So that is 80% of the 6,000. So that's how you get the phase out range if you're single. Again, the math works exactly the same. If you make 28,000, you're going to 128,000. You put 128 here minus 122. Work the math the same way. That's the phase out range. If you're trying to save into the Roth IRA, you can do it in a lot of different ways. You can save systematically, daily, weekly, monthly, or annually, however you want to save into it. Or you can wait until the end of the year and do it right before you file or the April filing deadline. So for 2019, you have all the way up until April of the filing deadline in 2020, because in 2020 of April is when you're going to do your taxes for 2019. So you can do it right then. And why would you want to do that? Why would you want to wait versus starting now? Well, if you're close or at the phase out range, you might not know where you're going to fall. Maybe you make a little bit more money, maybe you make a little bit less, and then you won't have to deal with excess contributions. Because if you over contribute into the Roth IRA, whether or not it's phase out or more than $6,000, if it's more than the amount that you can contribute, you're going to get a 6% excise penalty for the amount that's over the limit. So to avoid that, you can just wait until the end of the year, or you can do it systematically. Now, if you take the money out of the Roth before you file because you made a mistake, then you can avoid that 6%. It's an easy fix, but if you want to avoid it, then you want to make sure that you're doing it right before you file. So there's a lot of different ways. There's no one right answer. Whether or not you are saving systematically or at the end of the year, you want to make sure that you're saving the most you possibly can and the right amount. I hope this has helped. If you enjoyed this video, be sure to subscribe and leave your comments down at the bottom.